Hello everyone, welcome back to the CFP certification prep. I'm sure you all would have gone through the last video, which was the orientation of your entire certified financial planner certification journey. If you all have not gone through it, I request you all to first go through the orientation and only then start watching the further videos. Whatever we are going to learn in this video is basics of time value of money, certain concepts of finance, how do you use the calculator. This is what you all are going to study in these couple of videos. After you watch these videos, by the time rather you complete these videos, you will be a pro in how to use the calculator, and you'll also understand majorly how to use Excel sheet for doing these calculations of finance. After which you will start preparing for your specialist modules. So before you start preparing for your specialist modules, you need to watch these videos under the tab Basics of Time Value of Money. After which you will start your specialist modules, be it investment, be it retirement tax, or be it risk estate. So let's start with this basic of time value of money. I'm repeating this time value of money multiple times. What does that mean exactly? I'm sure a couple of you might already know, but I'm going to take this particular session or the video through very basics, like from the scratch. So if you think you already understand all these concepts, you are free to watch the video in a little speed, right? You can use 1.25, 1.5 ka speed, and then accordingly you can watch the video. Otherwise, go with the normal speed if you just want to understand everything from the scratch. So starting with the very first topic, without which nobody can become a CFP. Or if you want to do anything in finance, anything in personal, or in fact even corporate finance, you must know what is this time value of money concept. Somewhere, somehow you already know it, right? So let me explain to you what does this statement mean. Time value of money. So like the name says, the value of money does not remain constant over a period of time. So I can also say the value of money is not constant, and I can also state that value of money keeps changing over time. You all can make a practice of writing along with me, or the second option is first just listen to me and then pause the video and then make your notes. Even that is possible. For a couple of topics we do have presentations, but I prefer to teach while writing because that is the most interactive way. I don't want you all to just look at the PPT and doze off. Coming back. So the value of money is never constant or not constant. Or we can also say the value of money keeps changing over time. When I say value of money keeps changing, there are two things that can happen. Either the value of money will increase or the value of money can decrease. Either it can increase or it can decrease. What do I mean by increase or decrease? Let me give you an example. Like I said, either the value of money can increase or decrease. So let me give you an example first for value of money decreasing. Let's say you have $100 today. Let's say from that $100 you are able to buy one slice of pizza. Alright. Now, will you be able to buy the same slice of pizza, the same quantity after 3 years maybe for the same amount of rupees? That's $100. Difficult, right? Let me give you further more example. I'm sure everybody knows Kit Kat, right? The single 2-bar Kit Kat. This 2-bar Kit Kat that we used to buy a couple of years back was for rupees 5. The small one. Now if you want to buy the same Kit Kat, right, maybe with a lesser quantity in fact, you will have to pay not 5, but you will have to pay 10 rupees to buy the same commodity, same quantity. milk, bread, whatever, petrol, right? You all would have heard from your grandparents that we used to buy ice creams for like, pennies. They used to buy ice creams for charana and athana, etc. Now, what is the cost of the ice creams? 20 rupees, 30 rupees, and upwards. So, what does this mean when I say that earlier the price was, let's say, only charana, athana, and now you have to pay more money? What does that mean? What do you think? Do you think the value of money increases here in the KitKat example, let's say? Do you think that the value of money increased or did it decrease if I talk about KitKat? I used to buy it for 5 rupees, now I have to buy it for 10. Did the value of money increase or decrease? Answer yourself. The correct answer is that the value of money reduced or decreased over a period of time in this particular example of mine. In this example of KitKat or the petrol or the ice creams, the value of money is reducing over a period of time. 5 years, 6 years, 10 years back, I was able to buy KitKat for 5 rupees, but now I can't. With time, meaning as in 5-10 years have passed, the price of KitKat has increased. But the value of money has reduced or decreased. What I'm trying to say here is, I used to buy this KitKat for $5. But today that $5 is not enough. I have to add more 5 rupees to it so that I am able to buy the same commodity. And why does this happen? Why is the value of money not enough for me? Why is my purchasing power reduced? Why do I have to add more money to buy the same particular commodity with the same quantity or even lesser? What is the reason behind it? What is the reason behind reducing or decrease in the value of money? The reason is nothing but inflation. So the value of money decreases because of inflation. One of the major reasons is inflation. As in when you see the inflation rate is increasing, the purchasing power reduces and commodities become more expensive. But is it really the commodity becoming expensive? Ideally, no. It's the value of money that is reducing, because of which you think the commodity has become expensive. KitKat has now become or is now of worth 10. So I am not able to buy the same KitKat for 5 now because the value of 5 rupees has reduced. I have to add more 5 to it so that now the value of that money 5 plus 5 becomes 10, from which I'll be able to buy the KitKat. And that's why it is said that because of inflation, the value of money reduces or decreases over a period of time. I hope this is clear with a very basic simple example. So value of money can decrease because of inflation. But can value of money increase? When I say decreases, you're not able to buy any commodity for 5 rupees now, you have to pay more money. That means the value of money has decreased. But can I say that 100 rupees today that I had in my hand has now become 200 after 5 years? Double directly. That's no Lakshmi Chit Fund, guys. It's very simple. Today, if I'm able to invest 100 rupees in a commodity, the value of money can definitely increase after a 5-year period. If I invest that 100 in an FD, I might get some interest rate. Let's say I get 7% interest. I'm investing 100 rupees in an FD at 7%. After 1 year, I will be able to withdraw 107 rupees. Ignoring taxes right now, I'll be able to withdraw 107. So 100 rupees I had invested, I will get 107 out of it. Instead of paying more money, I'm getting more money. That means the value of my money has increased. Why? Simple. because I have invested my money and I've generated some interest over it. Because of this 7%, I'm getting the 7 rupees extra. So the value of 100 became 107 because of this interest rate. So I can say that the value of money can increase, for which one of the reason can be interest rates. Interest, rate of return, rate of interest, whatever you want to call it as. So because of interest rate, because of rate of return, the value of money can increase over a period of time. Now we all know that inflation in the economy is always going to be there with you, right? It is your best friend or enemy, whatever you want to call it as. Inflation, because is there in the economy, you can't directly let go or ignore it, right? But what you can do is you can try and beat inflation. Because as an individual, as a client, as a financial planner, when you will be thinking about your client or managing your own money, you would always want to think that how will my client be able to increase the money? How do I make sure that my client's 100 rupees do not lose its value? How do I make sure that rather the 100 bucks of my client that he or she has today increases in value and becomes 150, 200, 250, 300, whatsoever? For me to do that for my client, I have to make sure that I am trying and beating inflation. That's the lesson number 1. Now practically, I'm talking about practically, how do you beat inflation? Or what is the inflation in the economy? The inflation that you see in the economy today could range, over about 4, 5, 5.5%. But that inflation is calculated majorly assuming that a lot of part of my income, the money that I'm earning as a consumer, the majority part of my income I am spending towards food and fuel. And that's why majorly the inflation reflects the growth in food and fuel. Okay? But is that what majorly we spend on? We don't majorly spend on food and fuel. We have a lot of other expenses. What kind of other expenses do we have? We have other expenses like medical. We have other expenses like education. Right? There are furthermore expenses. There could be travel and many more where we do spend a lot of money. So what about this? What about the inflation to all these things? Do you think the inflation for technology is just 4%? No, right? The inflation for including all these lifestyle and necessary expenses is not only 4.5%, 5%. It is ranging approximate 10 to 12%. Now, inflation for the matter of fact or lifestyle inflation for each and every individual can be different. For me, inflation will be different. For you, lifestyle inflation will be different. It could be similar also, but it could be different also. Why and how? Maybe I am spending major of my money into education of my kids. But maybe you are spending majority of the money for medical of your parents. And maybe somebody else is spending major money in traveling. So it really depends on what kind of expenses do you have. So rather than just blindly following that, the inflation is 4.5%, try and find out for yourself or for your clients what could be the average inflation including all these expenses. So try and consider all these expenses of your client. I am talking about practical aspects. You don't really need to calculate inflation for your client in exam. Okay. I'm just trying to give you some practical insights along with theoretical insights because that is very important. So how do you understand or, calculate on an average what is the inflation that your client will be burning or your client will be impacting, right? So let's say medical, education, travel. Client might be spending 100 bucks, for example, in various expenses like these. Looking at what is the weight of the expense spent on medical, education, travel. and looking at what is the inflation in the economy for each of these. Based on that, you can calculate a weighted average and find out an inflation. That's one way of doing. The second way of doing is simply look at the economy, check through various websites, you will get this data. What is the inflation for medical, education, travel, household, clothing, food, everything. So try and find out the inflation rates for that and then accordingly do calculations for your client. You are going to learn weighted average and you're going to learn how to assume and consider inflation calculations for your client in further modules. Right now I'm just giving you a little trailer of it. Okay, I'm sure it's you're finding it very interesting. So this is how you try and assume an inflation. Don't just blindly go by 4.5-5% of the economy. If you assume that the inflation is only 4.5-5 for your client, you will try and target a return of only 5% and more, right? You will try and target that whatever inflation rate is more than that my client should be receiving. Only then there will be increase in the value of money. Because of inflation, my 100 can become 105 if it's a 5% inflation. So I would want that if my client is suffering from an inflation of 5, his 100 will become 105 means what? Whatever he was buying for 100 rupees today, you'll have to after a year spend 105. So what will I have to do? As a planner, I will at least have to target, let's say 7-8% return. If I target an 8% return, 100 bucks will become 108. So client will invest at 8% and will be able to withdraw 108. To beat inflation, I target for a return from my investment which is more than inflation rate. So 100 becomes 108. If let's say I'm investing in an FD which is giving me 8%. No FDs today giving 8% as such, but let's just assume. Let's say 108 is what I get. Now from this 108 as a client, from this 108, 105 is what I will spend for whatever my lifestyle expense I want to or necessary expense I want to. I will still have 3 bucks extra to save or to do something else about it. Spend it somewhere else. Look at my other goals. Here I'm just giving you an example from 100 rupees. Just imagine the kind of expenses that the client have. Monthly 40-50,000 is not, a huge amount now for an individual to spend for his family or her family. So I'm just giving you an example from 100 bucks. Imagine if this 100 was 1 lakh a month, 80,000 a month, 50,000 a month. The amount of savings will increase if you target a greater return than inflation. So you should try and beat inflation for your clients when you are making various strategies of investment. So to beat inflation, only and only to beat inflation, you can go ahead. If you want to beat inflation, you should make sure that you are investing at a better, much better rate than inflation in the economy or for your client. That's about increasing and decreasing of value of money. I hope this is clear so far. You all can pause and make a note if you all have not done that yet. Now moving further. Like we just understood, the value of money increases because of the interest rate. Now what are the kind of interest rates that are there in the economy? Let's talk about that. Okay, moving on further. So moving on further, like we know, the value of money can increase and decrease because of interest rate or inflation. We talked about interest rate, that if you invest, let's say 100 bucks, and if you get 7%, your value becomes 107, right? Now the interest rate that we are talking about are of a lot of types. But from our schools and colleges, we've always understood there are 2 types of interest rates. simple interest and compound interest. I'm sure you'll already know what is simple interest and compound interest, but even then, let me just give you a brief. If you already know what it is, you can just watch it and fast forward, like I said. Let me give you an example of simple interest. Let's say the interest rate is 10%. From any investment product or any investment instrument, you are investing, you're getting 10%. What happens in simple interest? Let's say you're investing in a bank. 100 rupees is what you invest and you get 10% interest on it. The interest amount is 10 bucks. Your principal, PRN means principal, is 100 rupees and your interest in percentage is 10%. So 100 into 10% is 10. In simple interest in the second year, what happens? Your principal remains the same. You have invested, you are not withdrawing. That 100 is as it is. You are not adding more money. Again, you will get 10% on it, which will give you 10 rupees. But if I talk about compound interest, in simple interest, you get interest on your principal. What happens in compound interest and why is it better? Let's say your principal is again 100 rupees. 10% is the interest percentage. In the first year, you get same 10 rupees. But in the second year, 100 is your principal. Compound interest will not only compound on or will not only be calculated on the principal, but compound interest is calculated on principal plus the interest of the previous time. 100 plus 10, that will give me 110, and on 110, 10% will be applied, which is 11 bucks. So in simple interest, the total that I get is 20 rupees in 2 years as interest amount, but here I get 21 rupees as my interest amount in compound interest. So obviously compound interest is better, but when I'm trying and explaining you this, understand that it's only 100 bucks. What if this amount was in lakhs, thousands or lakhs or crore? The difference between simple and compound interest will be huge. Here it is only 20 and 21, that is 1 rupee. But as the amount of investment increase, there will be a huge gap between what you earn in simple and compound interest. Obviously, the compound interest is going to be better when you are on the receiving end of the interest. So this is about simple and compound interest. One last concept for this video. We always know that compound interest is better and we would target that. But based on compound interest, there are two terminologies that we should understand, because we are going to use those terminologies while calculating sums or while solving some sums, trying and following a process. Okay. Initially, the sums will be very easy, numericals will be very easy. But in exam, numericals will be difficult, yes. Also, it will not only be numericals in the exam. There will be a lot of subjective theory questions also. So, we are going to understand the concept and the numerical both side by side. Starting with like I said, the last concept of this video, compounding and discounting. What is this compounding and discounting? Based on compound interest, we have this concept called as compounding. So what is this compounding? Let's say if you've invested 100 rupees today, okay, at a rate of 10%, like our example. This 100, because we are investing at 10%, is going to increase in value. The 100 becomes 110 in the next year. So when my 100 becomes 110, when the value of this money, 100 as on today, increases in a future date, okay, when my current value increases at a future date, it is called as compounding. when the value of my money increases over a period of time, the process of that money increasing in value is called as compounding. So I will just repeat it. Compounding is a process wherein your current value or current value of money increases over a period of time in the future. Your current value increases in future. That is what is compounding. Traveling from today to future is your compounding. Traveling from today to future. That is your present value, that is value as on today, becoming a future value. Not only that, but increasing in value. Let's say today's 100 rupees becomes 107. So my present value as on today increases in value at a future date. That process is called as compounding. The process of calculating the future value of today as in or the process. So basically compounding is what? The process of value of money increasing over a period of time. Current value growing in the future. That is what is your compounding. So your today's value increases in the future. As simple as that. That is the value of money as compounded. We use that when we want to calculate the value of a future date. Now similarly, on similar lines, there is something called as compounding and something called as discounting. So we've already understood what is this simple interest, compound interest, compounding. Now we are going to understand what is discounting. Compounding's complete reverse is discounting. Like the name says, discount. Discount means reduction in the value of money. So for example, let's say, you know that after a year you want to buy an iPhone of rupees 1 lakh. You already know that in the future you're going to need 1 lakh rupees to buy an iPhone after a year or so. How much will you have to invest as on today if you will be able to invest that money at a rate of 10%, let's say. If you are going to invest that money at a rate of 10%, how much are you supposed to invest today so that you are able to accumulate 1 lakh after a couple of years, or let's say a year, after 1 year? So discounting this value of money, traveling from future to today, doing a reverse calculation, calculating that how much will I need today if I need 1 lakh in future. Let's say I have to invest 90,000. If I invest 90,000, at 10% I'll be able to accumulate 1 lakh, let's say for example. So the process of calculating this 90,000 today, or the process of reducing the future value to today's value, is discounting. So in compounding you travel from today to future. In discounting you travel from future to today. This is what is compounding and discounting. So far we've understood what is time value of money, what is inflation or how does inflation impact the value of money, how does interest rate impact the value of money. And we've also understood what is simple interest, compound interest, what is compounding, what is discounting. I would like to end this video on one small question to you. If you have bought a lottery ticket from me, and let's say the lottery price is 1 lakh rupees. There are two options that you can, buy this lottery ticket from me, and if you win it, there are two options of claiming the money, claiming the prize. Let's say the prize, the winner's prize is 1 lakh rupees, which is either you can take this 1 lakh today. Let's say you won the lottery. So you can come to me and today claim your 1 lakh rupees, or you can claim this 1 lakh rupees after 2 years. Which option are you going to choose? Just think about it. Which option are you going to choose? Obviously, the answer is today, right? No brainer. You will buy a lottery ticket from me. I'll tell you that if you win, you will get 1 lakh rupees. I'll give you 1 lakh if you win the lottery. If your lottery number or lottery ticket number is pulled out, you win the lottery. Take your 1 lakh. When would you take your 1 lakh? I give you two options. Take your 1 lakh today from me, or I will give you this 1 lakh after 2 years. That is in 2026. You will obviously choose to just take that 1 lakh from me today itself. Why? One, because if I go for after 2 years, there is a risk. What if after 2 years I'm not there? I am just running away. That's a risk, right? You would not want to risk that. You would go for today's because you will get liquidity. You will get immediate money in your hand. You can use that for emergency. You can use that for whatever you want. For any goal that you have. So you have liquidity if you go for today. The second thing is, if you go for today, if you take this 1 lakh from me today itself, you can invest that money, and that 1 lakh can become 1 lakh 50 also after 2 years. 1 lakh 20, 1 lakh 50, whatever. But the value of money can increase if you invest, because you will invest at an interest rate. And interest rate helps you increase the value of money. So rather than going for 2 years later, I will go for today because I will get liquidity and I'll be able to invest that money and grow the money in value. If I would go for after 2 years, I'll still get 1 lakh. But if I go for today, I claim the money today, I invest it, I can make my 1 lakh 1 lakh 50. But the lottery money will still remain 1 lakh. So of course, I will go for today. That is very simple, and I hope everything is clear for all of you so far. If you all have any doubts, anything at all, you all can reach out to the doubt solving team to clear all these conceptual queries. When do you need to register with the board is after your basics of time value of money video are done. When you start your videos of specialist module, go ahead and register with the board. We'll keep reminding you that. Thank you so much. I will see you in the next video.